Hello, good evening, and thank you for joining us at the latest BetaShares Academy webinar. My name is Sarah Hare. I'm the Senior Marketing Manager here at BetaShares, and I'm delighted you can join us this Tuesday evening. Something a little bit different for us, but I hope you're enjoying the different time. Some important information this evening. Everything we talk about tonight will be general in nature, not taking into account any personal circumstances. Past performance is not an indicator of future performance, and before you do make any decisions, you should speak to a financial professional. Here during the session, of the slides and questions throughout, please use the widget on the right-hand side, type any questions, and we'll try and get to them at the end of the session. Here at BetaShares, we produce a range of content, and we try and keep you updated with the latest information, investment information, blogs, videos, webinars, and insights from a range of professionals, including David Bassanese, our Chief Economist. You can also follow us on the socials to keep up to date with the latest. So joining us tonight, we have had a change in agenda, and we'll have David Bassanese for the duration of the session. David is a former AFR columnist and author of Australia's ETF Guide. He's also responsible for the portfolio construction strategies at BetaShares and chair of the investment committee. It's my pleasure to welcome David this evening, and he'll be taking us through an economic outlook, an update of the markets, and some investment implications. Plenty to talk about with the recent US election. Welcome, David.
Thanks very much, Sarah. Thank you all for joining us tonight. As Sarah mentioned, there's a bit of an innovation here at BetaShares. We usually have these during a lunchtime, so having them in the evening just to see, if it's easier for some people to access the webinars and hear them live. And so I'm going to be talking for about 30 odd minutes, and we'll have some time for questions thereafter. And really just go through, the state of play in terms of the global markets, the Australian economy, some investment ideas that arise as a result of what's been going on. And obviously, I'm sure, as you know, if you read the papers, there's a lot been going on, even more than usual. There's always something happening in the global economy and financial markets, but this year has certainly been a year of exception in terms of just the sheer volatility of things that we've had to deal with: COVID, US presidential elections, recession in Australia, all these sort of things. So with that, let me just press on. So let me just start at the what really led us to where we are today in terms of COVID. And I'm focusing here on the US economy, and what this is the rate of new cases of COVID, 7-day moving average. It takes out the sort of weekly volatility or the daily volatility, and the death rates in the US. So the death rate on the right-hand side, the new cases on the left-hand side. And as you can see, the US is effectively going through its third wave of coronavirus cases. We had the first wave in March and April, then the second wave through June into July, and now it started to pick up. And in fact, since this chart was done, the cases have picked up to around about 100,000 a day on the due to the testing or whatnot. But what I wanted to highlight there is not only are they going through a third wave, but the death rate, and I think this is an important difference, is that what we're seeing is, yes, people are still dying and dying in large numbers, which is an absolute tragedy, but the rate of death compared to the new cases is still, less than what we saw during the March and April outbreaks. And we're actually seeing this in Europe as well. So Europe obviously going through a significant new wave of cases as well. But the death rates and the pressure on the hospital systems, not as bad as we saw back in March and April at this point. So we have seen lockdowns in forms of lockdowns going back into place in Europe. The UK France, parts of Germany. But in the US, and the other feature about the US is that the cases that we're seeing now are not so much in New York and California, which was the real driver of that first wave, and that led to the lockdowns in New York and Los Angeles and whatnot. It's more in the Midwestern states, the more, I was going to say lesser developed, but more rural, smaller towns, and where the political inclination to go into lockdown is a lot less. So what we're seeing is that the US, to some extent, is trying to learn to live with the virus without going back into lockdown. But it is touch and go as to whether or not that will remain the case. But at the moment, that has been the situation. And as a result, the economy in the US has continued to gradually recover, as I'll touch on in a minute. But that is the situation with regard to COVID. And now the other good news of that, I mean, to the extent there is good news, is that we're seeing in Asia, they still have the COVID well under control. So China has still got it under control and hasn't needed to go into lockdown. In Australia, obviously, we still have it pretty much under control now. Even Melbourne has finally got it under control. We're starting to open up in terms of easing social distancing restrictions. And of course, just overnight we had news on the vaccine, where the major drug companies saying they have 90% success rate, or positive results from the use of their vaccine that they're trialing. So as I've been saying through this year, I mean, there's so much work going on in terms of a vaccine that you've got to think, it's more likely than not that a vaccine solution will be available by early to mid next year. And so if that's true, we should be hearing these type of announcements by now, as we are starting to hear. This is a chart of what's called a government stringency index, and it's a measure of the tightness of policies or social distancing restrictions in various countries. And just to show you that we did get a ramping up of those in March and April, and they've generally come off. And some states they've come back on again. I mean, if you look at it carefully, you see in France they have tightened up again. But they've had, again, the lockdowns and the curfews and whatnot. But in the main, we haven't gone back to the sort of toughness of restrictions we had back in March and April. Is the main takeaway from that. And in fact, in Australia, we are progressively easing. In Melbourne, we've progressively eased as well, just in recent weeks. Now, what does this mean for the economy? Just going to the next slide there. And this is really, again, this is probably the single best summary measure of economic activity and the downturn that we've had, and how it compares to past downturns. So what it is aggregate weekly hours worked, and it's the percent decline. So the total sum number of hours worked by all the workers in the economy. And I've got a US and Australia compared, and what it is the decline from the previous peak level of hours worked. And so as you can see, we've had a number of periods where you've had significant downturns in hours worked, which are recessions. And historically, a recession typically is one where aggregate hours worked decline by around about 5 to 10%, and that period of weakness takes around about a year to play out. And as you can see, the big difference this year has been the sheer collapse in activity that was concentrated within a couple of months. And so in the case of the US, we had almost a 20% decline in aggregate hours worked relative to its previous peak level, twice as bad as we saw during the GFC a decade ago. But the good news is that all that happened within a couple of months because of those lockdowns. And as we progressively come out of lockdown and ease those social distancing restrictions, the economy has started to rebound. So I've got the months of 2020 blown up on the bottom slide there, and it just shows you, the nature of the collapse and recovery in hours worked. And in the dotted lines there is what we saw during the GFC a decade ago. As you can see, that was a much more gradual decline over a more extended period. So, with hindsight, that's why equity markets collapsed the way they did. They collapsed within a couple of months and then bottomed, and they've been starting to recover ever since, because that's how the economy has operated as well. It was a collapse, but we are still in this recovery phase. Now, the pace of that recovery, if you look at aggregate hours worked, has started to slow somewhat. We had an initial strong rebound, but again, it's still on course for recovery at this stage. I mean, there's no You know, again, barring a return to serious lockdowns across Australia or across the United States, then aggregate hours worked, I think, will continue to gradually recover as we head into 2021, which again bodes well for the equity market. Just some points on the looking at that, and the other, I guess, thing that's really supported the economy this year, the financial markets, has been that we've gone into this crisis with inflation around the world still incredibly low. And as you can see there on the first slide, inflation across the advanced economies sub 2%, and with the slowdown this year, in fact, it's in many countries dropped down to sub 1% and even 0. And so you've had central banks that already had interest rates at very low levels before COVID struck, cut rates even further to 0. And not only that, they're now promising to keep rates around these very low levels for several years potentially, until such time as inflation picks up to their target bands, which in most cases is above 2%. So central banks at the moment are saying we're not going to raise interest rates until that inflation that you see on the first chart there pushes back up above 2%. And as you can see, even going back 20 odd years, it's been very hard to see inflation sustainably above 2%. So to think that's going to happen anytime soon and central banks will respond by raising interest rates seems a very big stretch. And so the dotted lines on the second slide there are really market expectations for where they see interest rates going over the next couple of years. And as you can see, markets are not anticipating central banks budging on interest rates for quite a while. And in fact, you know, I actually think the bigger risk over the next, few years will be that it could potentially be an asset bubble, an equity bubble, because of low rates that force the hand of central banks to raise rates before inflation picks up. Because again, I just can't see it happening on the inflation front. And again, just to reiterate, inflation's been low for a long time for structural reasons, globalization, technology. Now we've got an added cyclical reason for low inflation, i.e. high unemployment caused by the COVID lockdown. So again, we need to get through that cyclical excess unemployment before we can even hope to get any upward pressure on inflation, which even before we had this high unemployment, was already being held down by technology, globalization, and these sort of pressures. So it's a big ask to expect inflation to pick up anytime soon. The other factor that's been supporting markets, of course, has been fiscal stimulus. As you look on the next slide, this is a chart I pinched from the Reserve Bank recent economic update, and it's a summation of the change in the budget deficit position across a number of countries as a share of GDP. And as you can see in 2020, that's added up to something like 8 to 9% of GDP across all those countries, compared to going back to the GFC, the last major economic crisis was around about 2% of GDP. So basically, we've got a fiscal stimulus about 5 times bigger than what we had during the GFC, to put an order of magnitude on it. And again, it goes back to the fact that most countries have seen the downturn as an undeserved downturn. It's been caused by lockdowns that we've needed to prevent the spread of the COVID disease. And as a result, they've been very forthcoming in providing a lot of support to households and to corporations, and that's really helped, I guess, underpin the economies, even though we had this period of contraction. And just on that, going back to the inflation interest rate story, also is that central banks, again, almost have a blank check to provide more stimulus if need be. I'm often asked a question, what happens when the stimulus runs out? What happens when the JobKeeper program ends? Well, the thing is, if the economy isn't ready for those programs to end, they will be extended. As is what I said 6 months ago, and they were extended. They were extended up until March, and if need be, they will continue to be extended because interest rates are so low, governments can run larger budget deficits, whether you like that or not. That's the reality. But if the economy does get enough traction, then they can be peeled back. That's what we want. We actually want to, reduce that fiscal stimulus as the economy strengthens and doesn't need it anymore. It is a balancing act, but you're basically counting on a policy mistake being done to think it would be pulled back prematurely. What does that mean for the household sector? Just going through to the next slide there. This is interesting. Look at the first slide there. You've had consumer spending, the orange line on the first top part of that slide there, consumer spending in Australia has weakened. And again, retail spending, so spending on goods, you know, TVs, laptops, clothing, food, that's all actually after at least after that initial collapse when we had the lockdowns, has actually bounced back in a very big way. People have been spending, retail spending has been quite strong, but services, obviously travel, tourism, these sort of things have weakened in a very big way, and that is a big chunk of consumer spending, and that's why overall consumer spending has weakened, and that's why the economy, of course, has contracted. GDP is about 60% of consumer spending. But what you can also see there is that income has actually accelerated, because there's been so many you know, government support payments gone to the household sector that income has held up. And in fact, as a result, the savings rate has surged. I mean, so households are awash in cash, and banks are awash in cash. I mean, they've got so much cash on their books, they don't know what to do with it. And that's why and that actually bodes well for the economy going forward, because households do have this cash buffer to spend as we head into 2021. And so I think that will actually provide a pretty good support for consumer spending more broadly as we continue to gradually ease the social distancing restrictions. Looking at the property market, I mean, that's also bounced back. That's just a chart there of the weekly auction clearance rate. So it's across the country, but most of that is in Sydney and Melbourne. That's where most of the auctions do take place. And as you can see, after that initial collapse, as you would expect, I mean, there was a period there where you weren't allowed to have auctions or even turn up and look at properties. But it has bounced back quite nicely. And in fact, only last week we had the the core logic measure of monthly house prices showed the first rise in national house prices in about 5 months. So I think house prices nationally have largely bottomed out and showed something less than you know, like a 5% or so downturn overall nationally. Through this COVID crunch. So it's certainly been a lot less than feared. I mean, many were talking about 10 to 15. You know, there's always those out there talking about more than a 20% crash, but we haven't had the forced selling that you need to see a property price crash. Again, many people with mortgages have been supported through JobKeeper to the extent they've lost their income. There's been interest payment holidays and whatnot that has supported the housing sector. And that will largely, I think, continue in place. Again, it's not going to be abruptly, the rug is not going to be pulled out from under the housing sector abruptly because the government will provide that support, and banks to a large degree will continue to provide some support as well. There will be some pain for sure, but it won't be of a widespread national degree that I think that would pull the rug out from under the housing sector. Certainly in terms of established property prices, the high-rise apartment business is somewhat different because we did get a period of overbuilding there for a while, and obviously international immigration and foreign buyer demand for high-rise apartment blocks has weakened. So that is going through a bigger adjustment, but certainly the standalone you know, traditional homes in Australia are holding up pretty well. Just go on to the next slide there. What about the US election? Just a couple of points on this. I mean, Biden, look, you know, you're reading in the papers that Trump is disputing the election result, and he's waging all manner of legal disputation. And those, you know, those that have been around for a while may remember the contested election of 2000. I've long said the biggest risk for markets is a drawn-out contested election where we don't know the winner for several months because it's dragged through the courts. And with postal voting being so significant this time around, that was the risk. Now, the big difference, I think, just to compare and contrast today with 2000, where you did have that extended period, back then it was a contested result in one state, Florida. The result was very, very close, and it was over the technicality of which votes should be counted, which shouldn't be counted. It wasn't over accusations of you know, fraudulent voting, you know, distorting the votes, those sort of things. So it's a far you know, the legal test was less then. You know, you just needed to question the technicality of certain votes in one state. Whereas for Trump to basically prevail this time around, Biden has won in several states and by a lot bigger margins than was the case in Florida in 2000. And Trump is talking about voter fraud, basically fraudulent voting, which is a much bigger test. You need a lot of evidence to prove that is true. So the legal hurdle for Trump to succeed is a lot higher than it was for the case of Gore. If you think back to 2000, actually Gore that was contesting the result. It was called for Bush in Florida, but he contested some of the ballots. Even then he didn't get up. But bottom line is, look, it looks like Biden is going to win. And in fact, the markets have seen right through the legal challenges of Trump. I mean, the risk of that contested election has not been factored into the market. Well, then basically the markets are looking through it. They don't believe it's a viable threat. And they've proceeded on the basis that Biden will be the next president. And also I guess from a market point of view, somewhat reassured by the signs that the Democrats didn't get a clean sweep through the Senate. If the Democrats had won the Senate as well, then it was more likely that, Democrat policies such as increasing corporate taxation, tougher regulation on industry, particularly the tech sector, could get up. Whereas now at the moment, the Senate looks like it's going to be pretty tight in terms of numbers. And there's 2 Senate races that still need to be rerun in Georgia. And even if the Democrats get both of them, basically the Democrats need to get both of those seats to make it 50-50 in the Senate. But even then, you need to pass legislation by 60 votes in the Senate because it can be blocked by what's called a filibuster. So all up, it's still very hard to see the Democrats being able to sort of get everything they want through the Senate. They'll need to compromise. And so that's going to curtail some of the things that the markets are worried about in terms of what might arise out of Biden. The good news in the immediate term is that once this election is now out of the way, markets will start to focus on a big fiscal stimulus package. I mean, whoever won the election was going to deliver another fiscal stimulus package. With Biden, it's not likely now until early next year because he doesn't take control till the 20th of January. But we'll be hearing more reports on what that would look like. And I think with Biden, it will be more directed at households. So expect another, check in the mail, so to speak, for households, an increase in unemployment benefits for those still on unemployment. Again, that's unemployment in the US is a state benefit provided by state governments, but the federal government has basically topped up those payments this year, and Biden will basically top those up somewhat more, would be, I think, at heart of the stimulus. So that's going to continue to support consumer spending in the US heading into 2021. Biden, I think the other heartening thing about Biden is he's going to be less erratic. I mean, he's not going to govern by Twitter, so we expect a more moderate, predictable, less erratic president. It may be less exciting for those that cover politics, but from the market point of view, I think that's going to be pretty reassuring. I guess one other aspect of it, I mean, there's a lot of things to talk about. We don't have the time to go through it all, but one clear point of difference between Biden and Trump will be a focus on cleaner energy, climate change. And so, cleaner energy, alternate energies type companies will be favoured relative to the more traditional fossil fuel companies that would have, held up relatively better had Trump persisted. So we're going to see somewhat more structural adjustment going on in that part of the market. I don't worry too much about big regulation of tech. Again, given the Senate issues, I think big tech, the Googles, the Amazons and Facebooks, probably their business models are, they're not going to be forced to break up or anything like that. There may be some extra regulation in terms of moderating user content, ensuring there's not hate speech and whatnot on social media platforms, but I think it's going to be pretty much at the margin rather than a serious threat to their very strong business positions. In terms of the market outlook, what does all this mean for markets? So just on the next slide there, just again, this is a slide of the Wilshire 5000, the US share market, so a very broad measure of the share market. The blue line is aggregate weekly hours worked. So again, it's that same indicator I showed you earlier about the downturn in Australia and the US, so aggregate hours worked in the US. And those grey shaded areas are US recessions. So there's a group in America that do define to the month when US recessions begin and end. And as you can see, they did say that the US did go into recession back in February. And at the moment, they haven't said we're out of recession. So we're still technically in a US recession. But what I wanted to highlight out of all of this is that the markets tend to bottom ahead of a bottoming out in aggregate weekly hours work. So it happened in, basically, you look at it 2000, 2001, even though the recession ended, it took a while for aggregate hours work to bottom out. And the market, as a result, the market took a while to bottom as well, well after the recession ended. In 2008, 9, during the GFC, you can see the market did actually bottom a little bit before the recession effectively ended. And that was because it still took a while before aggregate hours work to bottom out. That didn't happen until late 2009. This time around, if you look at it, we had that collapse in aggregate hours work, but you're probably fairly confident to say we have seen the bottom. And so aggregate hours worked are recovering. And as a result, it's probably fair call now increasingly to say that we have seen the bottom of the equity market in the same way that it does follow the, the trend. So unless you think hours worked is going to collapse in some way, the US economy is going to go back into sustained lockdown, then the bottom is in for the markets and for the economy, and we're in this ongoing gradual recovery phase now over the course of the coming year. Just looking at some, and drilling down a little bit more in terms of equity fundamentals. So this is a chart of the price index for what's called the global MSCI All Country Index. Bit of a mouthful, but it's basically the aggregate index of share markets around the world. And the bottom slide there is price to forward earnings ratio, so a measure of the valuation of the market. And as you can see, the market, because the market collapsed and earnings declined, you had that PE ratio, and then the market recovered, even though earnings have taken a while to recover. You've had that PE ratio blow out to around about 20 times earnings, the highest level we've seen in 20 years. But very much the two reasons that's happened is, firstly, as I mentioned earlier, interest rates have collapsed. So interest rates are incredibly low. So when interest rates are low, share market valuations can be supported at a higher level than would otherwise be the case. And in fact, if you look at it, the equity, so-called equity risk premium, which is the orange line on the bottom chart on the right, that's the difference between the equity market's earnings yield, which is you take that PE ratio, you turn it upside down, you get an earnings yield. You take away the bond yield and you get a relative measure of the market's valuation. And that's at the moment around about 4%, which is broadly in line with its long-run average. So funnily enough, yes, PE ratios are high, but given interest rates are so low, they're basically where you'd think they should be, given where interest rates are. Now, the other thing that's been pushing up that valuation is the fact that earnings have declined. But what we're starting to see, and you can see it on the top slide on the right there, is that earnings are starting to recover. So we had a collapse in earnings expectations for this year and next year earlier this year, but expectations for earnings globally have started to stabilise. And as you can see, the expected level of earnings in 2021 is still well above the level of expected earnings in 2020. Now, if that holds, then forward earnings, because it's a weighted average of those two measures, are continuing to rise. And the way that will work is that forward earnings, which is that orange line on that top slide, will continue to rise and touch that blue line, which is expected earnings in 2022 at the end of next year. Now, so bottom line, it gives you a very good tracking of where you think earnings will go depending on current market expectations. Now, if analysts suddenly cut back their expectations for earnings in 2022, then that forward earnings measure won't rise to that extent. But if they stay where they are, basically, if market analysts keep expecting earnings to rebound in a big way over the next couple of years, then forward earnings underpinning the market will continue to gradually rise over the coming years. So that's a chart I'm looking at carefully, and I've been very heartened by the fact that earnings expectations have stabilised over the past few months. So basically summing up the fundamentals here, interest rates are likely to stay very low, which supports the valuations given where they are. And meanwhile, earnings are starting to stabilise, earnings expectations stabilise, and we are starting to see earnings lift as we head into 2021. So a base case scenario here is that PE ratios maybe come off a little bit as interest rates, lift a little bit as the economy strengthens, but not by a lot because, again, central banks won't be raising interest rates. But more than offsetting some decline in that PE ratio will be on a rebound in earnings. So that's a sort of central case scenario I have in mind at the moment for the coming year. Just digging into the details of the market a little bit more. So what are some of the major? So what does all this mean for some of the major trends within the market? If we just go to the next slide there. And this is really the performance of different parts of the global market, their performance relative to that global aggregate index that I showed you earlier. So you can look at it by different regions, Japan, Europe, the United States, emerging markets, Australia. You look at it by various sectors like technology, quality, which are companies with high return on equity, the healthcare sector, energy, financials. So the standouts here is that US and technology have been the standout global performers in recent years. And in fact, COVID has only accelerated their relative performance. Things like energy, financials have remained under pressure, and the Australian market largely has continued to underperform. The other factor that's been holding up quite well is quality, which is companies with a high return on equity. And I actually think that, going forward, they are going to remain the relatively strong performers globally. So US market, tech exposures, which is not just the FANG stocks, it's global technology. So Asian technology are holding up pretty well, cybersecurity and quality is a factor. And our market, given we're sort of we're dominated by the financial sector, which I think will continue to struggle in a relative sense. I mean, maybe in an outright sense, the banks can show some gains here, but I think they're going to struggle to outperform relative to global markets. Then it does favour, global exposures over Australia and exposures outside of the financial sector for those looking for growth, that is. Just moving along, if you're looking at the Australian market in a bit more detail. So again, I've broken up these various sectors of the Australian market here. And again, this is relative performance to the ASX 200. And as you can see, really, financials have been in this trend period of underperformance for several years. Resources have had a good period of outperformance for a while, but that's started to unwind a little bit in recent months. But the absolute standout in recent years has been, again, I hate to say it, tech. Tech versus the rest, and we were seeing it globally. We're also seeing it in Australia. Now, the only problem with Australia, of course, is that tech as a share of the market is pretty small. So that's why, even though tech is doing well in Australia, it's not pulling our market up to the same extent it is doing, say, in the United States, where it's a much bigger share of the market. So tech, I think, will continue to do quite well in Australia. It's a very good growth sector. Other things to look out for next year, infrastructure, as you can see at the bottom slide there, it has tended to underperform a little, and it actually got hurt through this year as well when airports and toll roads and these sort of things got hurt by the COVID shutdowns. But in the search for yield and as social distancing restrictions ease next year, I wouldn't be surprised to see infrastructure, rebound as a sector next year as well. So just another one to think about. That's pretty much it, all I wanted to say on Australia. In terms of interest rates, looking at the more defensive parts of one's portfolio, I've got a slide there of interest rates on the first chart and the performance of bonds relative to cash. And basically, interest rates have been falling. And again, as you can see, there's been a trend decline in interest rates really since 2019. It accelerated through this year, and that has continued to see bonds outperform cash. And I think you can still get a decent yield pickup over bonds. I mean, the big strong gains in bonds from declining rates is probably past. But unless you see a big backup in bond yields, I still think bonds will offer a decent pickup relative to cash. So things like our long duration corporate bond ETF, CRED, and even long duration government bonds through something like AGVT still offering you decent yield pickups over the puny returns you're getting in term deposits. And that's just the other slide there, credit spreads and corporate bonds. As you can see, corporate bonds sold off in the early part of the COVID sell-off, but have rebounded quite smartly as credit spreads have come back in again. So again, duration and credit as yield pickups over cash in this relatively benign interest rate world, I still think makes sense. Now, just bear with me for 1 second. Just to summarise again, if you're thinking about global exposures, I mean, so just to really summarise some of the things I was saying, I mean, I mentioned technology. You know, here at BetaShares, we pride ourselves on really we've got a lot of different exposures, but some that we do have is in the tech sector across a number of fields like the Australian Technology Fund, ATEC, global cybersecurity through HACK, robotics and artificial intelligence through RBTZ, Asian technology companies, so it's like the Asian equivalent of the NASDAQ, if you like, through Asia, and of course the NASDAQ, you know, the world famous NASDAQ index in the US that has the likes of Google, Amazon and Facebook on it as well. So lots of different ways to getting that technology exposure through ETFs. I still think that's the really the standout thematic globally that we're going through at the moment, but a few others that are, you know, doing well at the moment are likely to continue to do well. Drug, I mean, if you want exposure to global healthcare companies, and some of which are doing very well with the work going on the vaccine, and you know, we're going to have one or several global vaccines for COVID next year, hopefully, which is going to underpin many of those companies that are succeeding in developing those drugs. And again, beyond that, global healthcare is still just a very good, strong global growth story, secular growth story with ageing populations and healthcare as a percent of GDP globally continuing to rise. Last but not least, and particularly given Biden has won the presidency, I think we're going to see a major structural shift even further toward, you know, cleaner energy stocks, environmentally conscious stocks. You know, the US will rejoin the Paris Climate Accord. The US will commit to having a net zero emissions by 2050. I think Biden is going to do that. And so, again, we have lots of different exposures that give you some companies in that area. Clean energy, Ethy, for example, is a global ethical fund. It achieves two purposes. It's companies with a low carbon footprint, but also not in any of the sort of socially controversial areas like, you know, alcohol, tobacco, these sort of things as well. And then, of course, on the Australian front, FAIR is our ethical Australian ETF as well. It strips out the fossil fuel producers, the banks that lend to miners, these sort of things, and also gambling and alcohol and all those sort of, you know, areas that you would expect. Last but not least, if you did want a whole diversified portfolio in terms of ethical investing, we have GBND which is an ethical bond ETF, and those are bonds that what is an ethical bond? It's a bond. The funds for which are used to fund environmentally useful projects. And so it's the use to which the funds are put. And so if a company goes out and raises funds for an environmentally useful project, then it can be classified as a green bond, for example, globally, and then that fund can invest in those types of bonds. So that's again, you can have a whole now ethical portfolio of covering global and Australian equities and bonds through 3 ETFs, Ethy, FAIR and GBND. So we try to make it easy for you, and so that's just an example of on the ethical front. So that's pretty much it. Hopefully we have some time for questions, and again, thanks for your time yet again.
Thanks, Dave. And just a reminder, a few things to keep in mind as you consider those investment opportunities, and please consider professional advice and make sure you do your research before you make any decisions. We've had a great number of questions come through. Thank you very much. I will just say that a recording of the session will be sent out with the slides probably tomorrow morning, so please keep an eye out for that in your inbox. The slides and the charts you'll be able to take some time over. I will just say David Bassanese writes, Monday morning he writes his Bassanese Bites, and it is a look ahead to the market, some key things that are going on, and then also just a quick wrap up of what's taken place. So if that does interest you, and he does keep those charts updated in that, you may like to jump on our website and subscribe to that. So we've got some questions, so I'll try and group them. And there's been a couple of questions about gold, and obviously we've seen a steep rise in the price of gold when the market was at its most volatile. So where do you see the gold price headed from here, and your thoughts on it being a worthwhile element as part of a whole portfolio?
Yeah, so look, I was in the early part of COVID, obviously gold did have a very strong run, and I was quite positive on gold, and again it played its role as a diversifier. So when equities sold off, central banks came to the party providing lots of stimulus. Gold rose, so it did do its role. Now I think as risk, sort of the risk sentiment is improving, interest rates are bottoming out, and in fact, longer term bond yields in the US have started to creep up a little. It's taking the edge off gold. So gold, to my mind, the key driver of gold is really the interest rate outlook. It's even more important than the US dollar if you look at the correlation over time. So with interest rates collapsing in the early part of this year, gold had a rally. Interest rates are bottoming out, and again, unless central banks have to do a lot more quantitative easing, I mean, again, going back to lockdowns and those, unless we have a relapse in the economic recovery, I think gold's pretty much topping out, to be honest. I'm not as bullish on it going forward as I was. But again, as part of a portfolio, I mean, I think it's still going to hold up. It's not going to collapse because interest rates are still going to be very low. Many interest rates around the world are negative. And so the opportunity cost of keeping gold in your portfolio is a bit of a tail risk option. Things go bad, gold will do well. In an environment where interest rates available elsewhere are pretty poor, and in fact negative in many cases, I think it's still going to be hold up in that regard. But I think the big bullish move in gold, and also I'm not a big believer in other people like gold because they think inflation is going to break out because of central bank stimulus. I've never believed that, and as a result, it's been hard to be a super gold bull because of that story, because I just don't think inflation will be breaking out in the way some fear.
And just a quick one, your AUD forecast?
Just on that, I mean, obviously in gold, if you did want gold, a quick plug there, we have QAU as our gold bullion ETF. So if you do want easy access to gold bullion exposure, have a look at QAU.
Your USD AUD forecast. It's a quick one.
Yeah, quick one. Look, I generally think the Aussie dollar, I actually think the Aussie dollar's sideways to down. I think in a 1 year's time, I think it's probably going to be closer to, say, 68 cents and 78 cents. And again, the reason for that is just I think the tech sector globally, the US economy is going to continue to relatively outperform and really the Aussie dollar, US dollar story is almost a US dollar story. It's a question, it's not so much do you think the Aussie is going to be weak, it's do you think the US dollar is going to be strong? Because that's the drive. If the US dollar is strong globally, Aussie tends to be weak against the US dollar. And I think the US dollar is bottoming out. And as we come out of COVID, you're going to see the tech sector globally continue to do well, and the US economy continue to do relatively well compared to certainly Japan and Europe, and that's going to favour. It's hard to be bearish on the US dollar in that environment.
And we've got a couple of questions about the RBA activity and their recent reduction of rates and what you think about that impact. And with rates at historic lows, is there a possibility for inflation to reach the 1970s range? And how do people position their portfolios for something like that?
Look, again, I think I don't see the case for inflation breaking out. Again, it goes back to those structural stories. Globalization. What does globalization mean? Is that, you know, companies can go anywhere in the world to source the cheapest, you know, way of producing things. And that's just going to keep downward pressure on costs. Technology is the other one. I mean, you know, ability to shop for the cheapest products online means that, you know, profit margins are pretty thin. And you know, people are just coming up with newer and better ways of making things at a cheaper price, and that's continuing to put downward pressure on costs and prices. And you know, the big shock back in the 70s was the oil price shock, where oil was a lot bigger part of the global economy. OPEC had control of the price and used their market power to jack up prices, whereas this time, you know, US is a swing producer of oil these days. OPEC doesn't have as much control over the prices it used to have, and it's not a bigger part of the economy as it used to be. So I can't see that as a big source of inflation. But with look, the RBA is basically, it's a public bottom line. I think the RBA's activities of late has been a public relations exercise to show that it's doing everything it can to support growth, even though it can't really do that much more. It's already cut rates to effectively zero. It's buying up government bonds, but you know, bond yields are already very, very low. It didn't really, you know, need to do that. But you know, we had people like ex-Prime Minister Paul Keating saying the RBA is not doing enough; it should be doing more. And the RBA basically sees no downside in doing more. Like, it's not going to cause inflation to break out. So if there's no downside in doing more and there's potential some, you know, good PR out of it, then do it. And so that's what they're doing. Now, the one risk, as I said, going forward is that the RBA at the moment is saying it's not going to raise rates for 3 years, and because it's not going to raise rates till it sees inflation back up above 2%. Now, I actually think it's going to be very hard to get inflation up above 2%. So that means they may never raise rates, you know, based on their current promise. Now, what will that do to the equity market if interest rates stay at zero for 3 years? You know, there's a risk of an equity market and housing markets getting, you know, out of hand. So I actually think that's the bigger risk for forcing the RBA's hand and global central banks' hand at some point over the next few years.
We have a few more questions, but in the interest of time and letting you get back to your evenings, we will reach out to those of you who have asked questions directly, just to make sure that they are answered. I will remind you that David Bassanese does a quarterly economic update, and that's in line with the RBA minutes, and that's well attended. And he does go into quite a lot of detail about the economic outlook and provides a great update. So thank you for joining us. Thank you, David. And we do hope that you have enjoyed it. And as I said, you'll get the recording and session slides tomorrow. Thank you very much.
See you next time.